Every January, millions of Canadians open their banking app, see new TFSA contribution room, and feel like they're doing something responsible with their money. But here's the uncomfortable truth. Most Canadians are using their TFSA in a way that quietly costs them money. Not because they're reckless, but because they misunderstand what the TFSA is actually for. The TFSA isn't just a savings account. It's one of the most powerful wealth-building tools in Canada. And when it's used incorrectly, the cost isn't obvious, but it compounds for decades. In this video, we are breaking down 7 common TFSA mistakes that quietly destroy long-term returns, and what to do instead. Mistake number 1. Leaving your TFSA in cash. This is the most common mistake, and the most expensive. Many Canadians open a TFSA and then leave the money sitting in cash, earning very little. Inflation doesn't care that your money is tax-free. If your cash earns less than inflation, your purchasing power is shrinking every year. The TFSA is not just a place to store money. It's a place to grow money, tax-free. If your TFSA is 100% cash with no short-term goal attached, you're likely wasting its biggest advantage. Mistake number 2. Treating your TFSA like a trading account. On the opposite end of the spectrum, some Canadians turn their TFSA into a day trading account. Frequent buying and selling, speculative bets, chasing what's trending. Here's the problem. Losses inside a TFSA are permanent. If you lose $10,000 inside a TFSA, you don't get that contribution room back. You also can't claim the loss for tax purposes. The TFSA rewards patience, not activity. Mistake number 3. Holding low-growth assets for decades. Some Canadians use their TFSA correctly, but fill it with the wrong things. Low-interest savings products, short-term GICs, ultra-conservative investments held for decades. These might feel safe, but safety without growth can be expensive over time. The TFSA is most powerful when it shelters growth from tax. Using it for low-return assets for 30 years underutilizes that shelter. Mistake number 4. Over-concentrating in one stock. Yes, gains inside a TFSA are tax-free, but concentration cuts both ways. Putting a large portion of your TFSA into one stock, no matter how confident you feel, introduces permanent risk. If it goes wrong, the damage isn't just financial, it's structural. That contribution room doesn't come back. For most Canadians, the core of a TFSA should be diversified, not dependent on one outcome. Mistake number 5. Ignoring U.S. withholding tax nuance. Many Canadians don't realize this. U.S. dividend stocks held directly inside a TFSA are subject to a 15% withholding tax on dividends, and you can't recover it. This doesn't mean you should avoid U.S. investments. It just means you shouldn't over-optimize blindly. The TFSA is still excellent for U.S. growth assets, but dividends behave differently than many people assume. Mistake number 6. Using the TFSA for the wrong goal. The TFSA is incredibly flexible, and that's part of the problem. Some people use it for retirement, emergency savings, home down payments, or short-term purchases. Individually, those goals can make sense, but mixing them inside one account often leads to suboptimal choices. Long-term goals want growth. Short-term goals want stability. When those get blended, the TFSA becomes inefficient. Mistake number 7. Not using your TFSA at all. This one is quieter, but devastating. Every year, unused TFSA room is lost time. You don't lose the room forever, but you lose the compounding. A dollar invested tax-free in your 20s or 30s is worth dramatically more than one invested later. The biggest TFSA mistake isn't choosing the wrong ETF. It's waiting. So what should you do instead? For most Canadians, a better TFSA strategy looks like this. Invest, don't park. Keep it simple. Prioritize long-term growth. Use diversification as your default. And match the investment to the time horizon. The TFSA isn't about being clever. It's about being consistent for decades. Because inside a TFSA, the most powerful advantage isn't tax-free money. It's time. And time rewards discipline far more than speculation. If you found this helpful, subscribe to Wealth Simplified, where we break down Canadian financial decisions clearly, calmly, and without the noise.